Okay, let's just jump right in. I want to start with a quick mental picture.
Yeah.
When I say the financial market, what's the first image that pops into your head, honestly?
Oh, it's always the same thing, isn't it? It's that guy in a bright colored jacket on the floor of the stock exchange, screaming into a phone, waving a slip of paper. Total chaos.
Totally. It's loud, it's frantic, and it's very, very human. But the big idea we're tackling today, and this is based on a huge pile of research from NeoDataNet, is that image, it's basically a museum piece now.
It's gone. That world just doesn't exist anymore.
And today we're making the case that financial markets aren't people shouting or even just people clicking buttons. They've evolved. They're now what you'd call complex adaptive systems.
Right. Think less like a spreadsheet and more like a biological entity, a vast automated ecosystem.
That's a huge shift in how we think about this stuff.
It's a profound shift. We're moving away from this idea of a market being a machine. We can just, tune up with a wrench. It's more like an ecology now. And if you treat a jungle like a car engine, you're going to get eaten.
So to guide us through this jungle, we're looking through a very specific lens. We're doing a deep dive into the work coming out of NeoDataNet research. And this is where it gets really interesting for me. They're not doing this from Wall Street.
No.
Or London. They're spearheading this whole next-generation infrastructure from their research hub in Africa headquarters, in Ghana.
Which is so significant. It's a real paradigm shift. It signals that we're not just, iterating on the old models. We're building something new from the ground up to handle this new reality.
And NeoDataNet, they have this very clear three-part mission that's basically our roadmap for today. Part 1, markets will inevitably automate.
A given at this point.
Part 2, this automation creates just massive amounts of data.
Yeah.
And then part 3, and this is the real kicker, someone has to own the observability layer.
That third point is everything. We need what they call instrumented systems. I mean, think about it. In science, if you can't reproduce an experiment, it's not science.
It's just a story.
It's an anecdote, exactly. For so long in finance, I had a hunch was an acceptable strategy. NeoDataNet is saying, no, we have to capture the decision process, the data, the outcome, so we can make this research actually reproducible. Testable.
So this is about making markets understandable again, not just profitable. Okay, so let's dig into that first pillar, the new paradigm. You used the phrase complex adaptive systems. Can you break that down for us?
Of course. So to get the new, you have to look at the old. Traditionally, finance used models like, say, the capital asset pricing model or CAPM.
Yeah.
And these models are built on this idea of rational actors. Everyone has the same information. Everyone acts logically to make the most money. And the market just sort of settles into a nice, calm equilibrium.
Which, if you've ever spent 5 minutes on the internet, you know is complete nonsense.
It's a useful simplification for a textbook, maybe, but it completely fails to explain reality. The research points out that these old models can't explain what they call stylized facts.
Stylized facts. That sounds like a very polite way of saying the things that prove our model is broken.
That is precisely what it is. And one of the biggest ones is fat tails.
Okay, what are fat tails?
So in a normal bell curve, right, an extreme event is supposed to be almost impossible. A massive market crash should statistically happen, I don't know, once in a billion years.
Not in reality.
In reality, they happen every decade or so. The tails of the probability curve are much, much fatter than the math says they should be. The impossible happens all the time.
So the map just doesn't match the territory at all.
Not even close.
Yeah.
And then you have something called volatility clustering. This is where things will be dead calm for ages, and then suddenly, with no big news, the whole system just goes wild. The old math assumes every day is independent.
But in a complex adaptive system, everything is connected.
Everything. A small shock in one corner can ripple. It can cascade through the entire network in these weird, nonlinear ways.
The crashes. The moments where the math is screaming, this shouldn't be happening. But your portfolio definitely is.
Right. So this is why the research is pushing this idea of a human-machine social system. It's an ecology. You've got your humans, but you also have these intelligent machines, these bots, and they are completely interdependent.
So it's not just tools. It's more like a coral reef or something.
That's a great analogy. You can't understand the health of the reef by only looking at the fish, and you can't understand it by only looking at the coral. You have to look at the interactions.
That sounds incredibly hard to study.
Yeah.
I mean, if the old math is useless, how does anyone figure out what's going on? You can't exactly put the global economy in a petri dish.
Well, actually, you kind of can. You just need a different toolkit. The research highlights something called agent-based modeling, or ABM.
Okay.
So instead of a big top-down equation, you simulate the market from the bottom up. You create thousands of little software agents.
Like characters in a video game.
Sort of, yeah. You program some to act like cautious pension funds. You program others to be super aggressive, high-frequency traders. You give them all different rules, different behaviors, and then you hit play. You grow the market in a computer to see how these cascades actually happen.
That's wild. It's like SimCity for Wall Street.
It's what you have to do now, because the creatures inside that simulation are evolving. Which brings us right to that second pillar we talked about. Markets will automate.
Right, our second roadmap point. We said markets will automate, but looking at some of the source material on crypto algo development, it seems like that ship sailed a long time ago.
Oh, it's well underway. And the variety, the biodiversity is just staggering. We're not talking about one kind of trading bot. It's a whole food chain.
I was looking at the returns on some of these strategies, and they are just eye-watering. You've got your basic market making, maybe 18 to 35% returns.
Yeah.
But then you see something called liquidation hunting.
Liquidation hunting, it sounds predatory because it absolutely is.
The source material returns of 45 to 90% for that strategy. What is that? What is a liquidation hunter?
So in markets where people trade with leverage, with borrowed money, if the price moves against them too much, the exchange just automatically sells their position to cover the loan. That's a liquidation. These bots are programmed to sniff out the exact moment a trader is about to break.
Wow. So they can smell blood in the water.
Literally. They swoop in, buy that distressed asset for pennies on the dollar, and sell it moments later. Sometimes they even push the price just that tiny little bit needed to trigger the liquidation themselves.
They're the vultures of the ecosystem.
Or the apex predators, depending on your view. But they need incredible infrastructure to do this. We're talking nanosecond level speed, access to so-called dark pools, private exchanges where you can't see the orders coming.
And this is all AI driven now, right? It's not just a simple script.
Increasingly, yes. The AI-powered strategies using massive data sets are showing returns of 40, even up to 120%. But all this automation, it's not a peaceful garden. It creates conflict. It's a constant war.
This brings up a really interesting point from another source on something called LVR, or loss versus rebalancing. This is a bit technical, but I think it's important. It's about automated market makers, AMMs, like Uniswap.
Right. Think of an AMM as a robot shopkeeper. It's always there, ready to give you a price on, say, Bitcoin versus the dollar. It has a simple formula.
But the source says AMMs are lazy. What does that mean?
It means they don't proactively check the news. They only change their price when someone actually trades with them.
So if the price of Bitcoin suddenly jumps 5% everywhere else in the world, the little robot shopkeeper on the AMM has no idea.
No idea. It's still offering to sell you Bitcoin at the old, cheap price. And this is where the snipers come in. These are arbitrage bots. They see the price difference. They race to the lazy AMM, and they buy up all the underpriced Bitcoin before it can adjust.
So the AMM loses money. It just sold an asset for less than it was actually worth.
That's the LVR, the loss versus rebalancing. The AMM is constantly getting picked off by these faster, more informed sniper bots. It just reinforces this idea that automation isn't just set it and forget it. It is a high-speed war for liquidity.
You have the slow-moving grazers and the lightning-fast predators.
And that's the new normal.
Okay, so we've got this chaotic biological system full of vultures and snipers and lazy robots. But all of this, this activity must leave a trail, right? Which gets us to pillar 3. Automation generates data.
It does. And this is where the story gets really counterintuitive. You'd think with all this high-speed activity that markets would be incredibly liquid, that you could buy or sell anything in an instant.
Yeah, that's what I'd assume. High volume means high liquidity, doesn't it?
You'd think so.
Yeah.
But one of the sources we looked at from Bouchot and his team, it reveals something pretty shocking. It says that revealed market liquidity is extremely low.
How low is extremely low?
So low that if you wanted to buy just 1% of a large company's stock, it might take you between 100 and 1,000 individual trades.
1,000 trades? Why?
Because you can't just drop a huge order on the market all at once. If you tried, you'd signal your intent and the price would skyrocket against you. There isn't enough standing liquidity to just absorb that kind of a shock.
So the market has to, what, digest the order slowly?
That's the exact word they use in the research. Digestion. There's a concept called the long memory of order flow. If a big pension fund wants to sell a massive position, they don't do it at once. They engage in strategic order splitting.
Strategic order splitting. So it's like trying to sneak an elephant out of a room one spoonful at a time.
That's a vivid image. But yes, basically, they chop the order into thousands of tiny random pieces to hide what they're doing. And because of that, the pressure from that big order, it lingers in the market for weeks, sometimes months.
So you're saying a price move I see today might not be because of today's news? It might be the echo of a decision made 3 weeks ago.
Precisely. We're always looking for a neat story. The Fed said this, so the market did that. But a lot of the time, it's just what they call mechanical impact. Prices move simply because a buyer shows up. The price has to move up mechanically to find a seller. It has nothing to do with news or the company's value.
And the bots see that mechanical movement and react.
Yes. This leads to what the research calls herding. One algorithm sees a price tick up, interprets it as a new trend, and buys. Then 10 other algorithms see that algorithm buying, so they jump in too. They create these feedback loops that a human might mistake for some big, important news.
But it's just the machine digesting its food.
It's just the internal mechanics of the system.
Okay, so this sounds like, well, a complete mess. It's chaotic, it's dominated by warring bots, and the cause and effect are separated by weeks. How can you possibly study this?
It is impossible to study, unless you own the observability layer.
And we're back to Ghana. Back to NeoDataNet. Their whole argument is that because of all this complexity, you can't just look at the stock ticker anymore.
You need to own the layer that observes. You can't just see the price. You have to be able to see the decision logic. You have to see why a trade happened in the first place.
There was a source on an agentic AI framework that really lays out how this solution could work. This feels like the core of the NeoDataNet innovation. It's not just recording data, is it? It's about governance.
Correct. They're basically designing a government for these multi-agent systems. The architecture is fascinating. It starts with a primary orchestrator node, or PON. Think of it like the project manager, the brain that breaks down big tasks.
Okay, a manager for the bots.
Exactly. But the most important piece, the bit that solves the whole black box problem, is something they call the causal traceability ledger.
Causal traceability ledger. That sounds important.
It is. It's a cryptographic log of every single action taken by every single bot. But here's the crucial part. It doesn't just record the trade. It records the reasoning. What data did the bot look at? What logic did it use? What was its confidence score for the decision?
So that's how you make the research reproducible.
Reproducible, observable, and testable. Remember their mission statement. This is it in action. Without this causal audit trail, these automated systems are just untrustworthy black boxes.
Right. Because if a bot goes haywire and tanks the market, and you ask why, the answer can't be, I don't know, the neural net just felt like it.
That is completely unacceptable for mission-critical finance. If you can't trace the cause, you can't manage the risk. The framework also has a synthesis and reconciliation module, which basically resolves conflicts. If one bot's data says buy and another says sell, this module helps figure out what's true.
It really is like building a government for the bots. It's putting rules and order on that biological chaos we started with.
That's it. It's bringing order to the jungle.
So let's zoom back out. We started with markets as these complex biological things. We talked about the predators, the hunters, the snipers. We talked about how the market slowly digests these huge chunks of data. And we landed here with this very structured, auditable observability layer being built by NeoDataNet.
It's a really comprehensive vision.
I just want to circle back one last time to the location. Why Ghana? Why not just stick another server rack in a basement in New Jersey?
Legacy. It's always legacy. The hardest part of true innovation is often unlearning the old ways of doing things. In New York, in London, you're dealing with decades of old systems, old code, old thinking.
But we've always done it this way, crowd.
Exactly that. By building their research hub in Africa, NeoDataNet is essentially technologically leapfrogging. It's like how many nations skipped landline phones and went straight to mobile banking. NeoDataNet is skipping the old clunky infrastructure and building the native infrastructure for this new agentic world from scratch.
They're building the natural habitat for the next generation of financial markets.
And by focusing on owning that observability layer, they're grabbing the most valuable real estate in their entire new ecosystem, the ability to explain why. In a world of black boxes, the person with the flashlight is king.
Here's a final thought for you to chew on then. Something that keeps bugging me as we talk about this. We describe this human-machine social system, this market that digests information like an organism.
Yeah.
Well, if the market is becoming a fully automated biological system that we just feed data, are humans still the drivers? Or are we just becoming another data point for the observability layer to track? Are we the masters of this machine, or are we just the food that it digests?
That is the ultimate question, isn't it? When a system gets complex enough, the line between the creator and a component of that system starts to get very blurry. We might just be the noise the algorithms are trying to filter out.
On that slightly chilling note, maybe think about observability in your own life. How much of your data is being digested right now, and who, if anyone, is watching the ledger?
It is definitely worth considering.
A huge thanks to the NeoDataNet research team. The source material was incredible. This has been a truly fascinating deep dive.
My pleasure. It was great to explore it.
We'll catch you on the next deep dive. Stay curious.